A week ago when I published my video, I really thought this past week could be pivotal, but instead it turned out to just be blah. I should have known better with the Fed meeting coming up this next Wednesday that the markets would at best tread water this past week. Last week I described the markets as listless, directionless, but not terrible. This week I would describe the markets as trending toward higher risk, but not to the point where we're ready to put a hedge on in our clients' portfolios. With that gloomy outlook, let's dive into the analysis and see how things look now after sideways to downward move for equities again this past week. So as you can see, when we look back over the past week, the equity markets all finished lower. And in fact, this is a fairly unhealthy looking week with ARK Invest finishing dead last, NASDAQ second to last, and so on, with the Dow finishing the best, if you want to call that the best, although even ARK only finished down 2.71%. So that's not a horrendous week. It's just not a great week. And if we look back over the past month, you can see that we've got a very healthy rally, although it's tailed off here at the end. ARK is in first, NASDAQ second, S&P third. Small caps last, but Dow second to last. So this isn't bad at all. This doesn't look too bad. What about year to date? Well, year to date, we still have a very healthy rally, extremely good gains. ARK up 41%, NASDAQ up 40%. Even the S&P's up 16.4%. This is a really healthy looking market.
I'm afraid to say how I feel.
And what if we take a look at the bottom dynamics? Well, the bottom dynamics have been kind of wild lately. So when we look at the bottom dynamics, you can see that we had a bottom forming indicator here, this orange line, up at 100% for quite a while, for over a week. But you can see that the confidence level for risk, this dark dashed line, was well below 80%. This is not a strong indicator, even though the market actually bottomed out here. Now, what's happened since then? Well, we had a bottom confirmation up here at 100%, but now the confidence level was at, I think, 96%. So this is an indication that we've seen a bottom here. Like anybody need to tell us that, right? But then what's happened lately? Well, you can see that the confidence has been declining slowly and then really trailed off here at the end. But it trailed off as the bottom forming indicator started to shoot up again. So if I were going to base it just on this graph, I'd say we're going higher, at least the early part of the week. But we don't know what's going to happen with the Fed meeting, and that could throw a wrench into everything. Also, the other metrics that we're going to look at aren't looking quite as promising as this one. So let's take a look. If we look at risk versus opportunity, you can see that the opportunity level has been declining as the market's been going up. That's not good. And you can see that the risk acceleration has been steadily increasing and is pointing straight up here at the end on Friday. And then the risk, this red line, also it has been declining, not increasing like risk acceleration. But you can see on Friday it also started to point higher. Now, these are not at a level where I would have any reason to be concerned. I'll be concerned when risk acceleration is above 60 here and when risk itself gets up above 80, which would be up here. So we're a long way from that. But these are the old metrics. Now let's take a look at the new metrics if you really want to be confused. So here are the opportunity, risk acceleration, and risk graphs for the new metrics. And what do we have here? A very confusing picture. You can see just like for the old metrics, risk acceleration has been moving higher. But unlike the old metrics, risk acceleration is almost up here at 80. This is giving me a lot of pause. And you can see that risk, this red line, is really starting to ramp up and move higher here. Now, here's the conflicting part. You can see that the opportunity level has been steadily increasing since way back here, since before the bottom. So this is saying, hey, things are good. The water's fine. No sharks anywhere. And these guys are playing Jaws. So I don't know, really don't know how this is going to play out next week. It'll be interesting to see what happens before and after the Fed meeting.
Wanna let you down with
Now I'm going to do something I haven't done before. We're going to show equity versus safety using the old metric, and we're also going to look at it using the new metric. Now the reason I haven't used the old metric before is because we just started running our software with the new metrics back on August 4th. So I wanted to have seven columns here in a row to be able to show you. And this is the first week I can do that. So if we take a look at the NASDAQ 100, going back here with the old metric, it started out here, dropped to here, not good. Kind of came back a little bit, which gave me some encouragement. And then where did it go? Oh, there it goes. All the way up here to first place. That's why I couldn't find it. And then it has stayed in first place for 2 weeks. And then this week it dropped down to fifth position. So this is concerning for sure. Let's take a look at cash because you got to follow the cash. So if we look at cash, cash was up here in first place, really bad. Stayed there for 3 weeks. Fell back here, which was really encouraging. But then last week went back up to here, which gave me some concern. And then this week it's in first place. Now, I'm going to show you this same table, but with the new metrics, and you'll see it's a slightly different look. So let's take a look at that. So here we are looking at the same table, but using the new metrics for equity versus safety. And you can see the NASDAQ 100 started out down here, went lower, just like before, lower, came back a little bit, just like in the previous table. But here's where they really part company. It shot up here to second place, then to first place, and it's still in first place. This looks really good. What about cash? Well, if we look at cash, cash stayed in first place all this entire time. And then last week it fell to second place, and this week it's in third place. I think this is going to be a real tell here going forward. Do we believe the new metrics, which are saying, hey, things are fine and cash is declining in its ranking? Or do we believe the old metric where cash is in first place and has been moving higher? I think this is going to kind of wash out which one of these is the better way to look at things.
Don't wanna let you down.
And how does all of this show up in the buying and selling pressure? Well, you can see that the Dow had a fairly nice rally here. It kind of pulled back, went higher, and then, of course, on Friday dropped. And you can see that the buying pressure, the solid gray line, has fallen below the selling pressure, which is the orange line. But neither one of them is at a very big value, so it's kind of a mixed picture. What about the S&P 500? Well, if you look at SPY again, rally, pull back, higher, not quite higher than this peak though. Not that there's any significance to that, but you can see that the buying pressure, this solid gray line, is above the selling pressure currently, although it's heading lower. NASDAQ 100, similar picture. And again, the buying pressure, solid gray line, above the selling pressure. So that's encouraging. And then if you look at ARK Innovation, it really has kind of pulled back the last several days. And the selling pressure has increased here and the buying pressure has decreased. So that's not very encouraging. And what about small caps? Well, if we look at small caps, you can see that we've had a big decline in price, a nice rally here, a pullback. They're well below this previous peak here, and the selling pressure is well above the buying pressure. So this really doesn't look good for small caps. Okay, let's take a look at sector rankings because these give you a very robust picture of what's going on in the markets when we look at all these sectors. And you can see that last week in this top table, we had a very healthy looking picture. Technology, the NASDAQ 100, technology here, consumer discretionaries. We had semiconductors here, Bitcoin up here. We had ARK Innovation here. But more importantly, cash and treasuries and gold and consumer staples all were down here at the bottom. These are safe haven areas, all at the bottom. Now, what about this week? Now, again, this is the old metric. So this week looks really good. Consumer discretionary up here, NASDAQ 100, Bitcoin. We've got technology. ARK Innovations moved up a couple of slots. And again, cash consumer staples, gold, treasuries, all down here at the bottom. You might hear my cat in the background. And you can see the consumer staples actually moved lower. This looks great. Well, let's take a look at the new metrics, see what kind of picture we get there. So if we look at the new metrics last week, in this top table, you can see that we had Bitcoin up here at the top, but the NASDAQ was fairly far down here. But if you look at the Dow, it was behind the NASDAQ, which is great. And then we had consumer discretionary up here. So again, big picture, cash, consumer staples, treasuries, all down here at the bottom. Nothing could be better. Now let's go to this week. Bitcoin's still at the top. We've got consumer discretionary up here. This is great. But what I don't like is you can see that Dow and SPY are leading the NASDAQ 100. So these are doing better than the NASDAQ 100 in the rankings. And then we've got innovation. ARK Innovation has moved down here, but it was down here last week, so actually no movement. But what I don't like is you can see how cash, treasuries, consumer staples, and gold are all sliding up. So not a good picture when we look at the new metrics. Now let's take a look at sector rank acceleration, because these move fairly quickly. They kind of point to where things are headed and give you another look into sort of the undercurrents of the market. And I don't know if you can hear my cat, but he's howling over there. He's funny. Anyway, in this top table, you can see the technology ranked number 1. This looks great. We've got technology here again, consumer discretionary up here. We have where's innovation? ARK Innovation down here. So that's not that great. And you can see the cash, treasuries, and consumer staples again, all down near the bottom. So really nothing to be afraid of here. Fast forward to this week, consumer discretionary is number 1. Now, ARK Innovation has moved way up here. That's crazy, right? From down here to all the way up here. And then we've got the NASDAQ 100 here, technology, and it's well ahead of the Dow and the S&P. So that looks very healthy. But what's happening? Cash, treasuries, consumer staples, and gold have all slid all the way up here, and they're moving in the wrong direction. We don't want them going that way. So this is giving me some concern looking forward. And what if we take a look at the new metric? Well, if we look at the new metric, there's really not much risk up here. We've got the Dow and the S&P 500 up here, the NASDAQ 100 all the way down here. This is really not a healthy appetite for risk. We've got consumer staples and cash up here, and gold and treasuries. Last week, this didn't look good. Now, if we look at this week, it's gotten a little worse. You can see cash and treasuries and gold have all moved up. Now, consumer staples moved down, and consumer discretionary moved up. What do you make of this? I mean, it's a very mixed up picture. So not concerned yet, because when you have reason to get concerned, these things will be much less, or let's say much more definitive than they are now. This is giving somewhat of a mixed picture, even though cash is moving up like this. So we're just going to have to wait, see how next week plays out. So maybe next week could be pivotal. And how have treasuries been doing? Well, if we look at this past week, not a good picture. They tried to rally here, a very nice rally. And then Thursday and Friday, they just plummeted. So this is an unhealthy looking picture for treasuries, with the longest duration ones falling the most. Now, they only fell 1% at the very long end, 0.78% for 20 years. So not horrible, but this is an unhealthy looking picture. What about over the past month? Well, if we look at the past month, tried to rally, but we're kind of nowhere here. We're in the negative column, but not in a big way, less than 1% across the board. And then if we look at year to date, we're way down. The longest duration treasuries are down over 11%. 20 years are down over 8%. And then let's take a look at 5 years to see where we are relative to things. Well, we're not far off of this bottom back here in October. So again, this may turn out to be a good time to be buying long treasuries, as long as interest rates don't go higher. If they go higher, all the bets are off, and these will fall even further. And how does all of this price action in treasuries show up in the buying and selling pressure? Well, you can see that actually the short duration treasuries have been on a fairly nice rally here. This is, you look at this and this price ending up here is a lot higher than this price here. But more recently, the selling pressure, this orange line, is not only above the buying pressure, it's moving higher. What about intermediate treasuries? These are usually somewhat safe, but clearly not in the recent past. You can see that they've been declining in price. And as you look at the selling pressure of this orange line, it's pretty much above the buying pressure all the way across here, except for this little bit of time right here. And recently, it's well above the buying pressure and moving significantly higher. Not a good picture. What about 7 to 10 years? Again, take a look at the selling pressure. It's been above the buying pressure almost this entire time. The price has been declining, and the selling pressure is now above the buying pressure. How about 20 years? Again, declining price, selling pressure above the buying pressure, except for right back here, and selling pressure moving higher recently. So not a good short-term looking picture for treasuries unless the Fed says something that makes them move on Wednesday. And how's the yield curve looking? Well, not much has changed here, honestly. I mean, the yield curve is still inverted by 72.92 basis points, or 0.72, 0.73%, call it. So it's still very inverted. And you can see that not much has changed since a month ago. Although a year ago, you can see that it had just inverted. So when we've looked at these in previous weeks, a year ago, this was not inverted. And you can see here that it was just starting to become inverted 1 year ago. And you can see now with the Fed meeting this coming Wednesday on September 20th, there is a 98% confidence level that the Fed will not raise rates, and only a 2% confidence level that they'll raise rates at all. So the Fed usually does what this thing is saying because they don't want to jar the markets. And let's take a look at how the inverted yield curve has looked over time. If you've seen my previous videos, you'll know back in March, over a year ago, that this was inverted 111 basis points, as you can see here. And it was inverted another 111 here, and, very severely inverted here. And now we're just kind of noodling along here at minus 72, minus 73 basis points. So this has a long way to go to become uninverted.
I feel like I'm afraid.
And what about gold? Yep. Gold is one of the maybe bright spots here, but you can see the price has really declined. It tried to rally, pulled back, but actually on Friday it went up, and the buying pressure moved up with it. So if this trend continues, gold will go higher.
Of your heart, you can
And then let's take a look at Bitcoin. Now, Bitcoin has been the only bright spot in this mess. And you can see that we've had a nice rally here, a big peak here, and then it fell off a little bit on Friday. But you can see that the buying pressure, even though it's declining here, is still well above the selling pressure. So maybe this means Bitcoin will go higher next week. I don't have any way to predict that, but so far it looks good.
if it's only
A week ago, I was hoping the markets might start to move higher, but then again, there's the Fed meeting coming up in a few days on Wednesday. This past week, equities meandered again and finished in a confusing downward move with no conviction. But this time, we're starting to see some signs that things could possibly become unhealthy. With the Fed meeting and decision in a few days, this next week could finally be pivotal and set the direction for the next few weeks. Until next week, I'm Calvin Rose, and thank you for watching Invest Smarter. That's all for now.
So you